Hi there. This is the E.M.I for the month of October. Let's jump right in. In this month's E.M.I, as usual, we ask a few questions. How has public sector capex spending been in the past few years? What can one say about private sector capex in India? How strong is the underlying momentum in capex from center and the states? And lastly, when compared to its global peers, how does India stand on capex intensity? There is so much talk about consumption nowadays. So let's talk about capex instead. Public sector capex saw a strong jump on services capex in the last few years. Now, what is public sector capex, or let's say government capex? How does it look like? 1/4 of India's capex comes from the public sector, 1/3 from the private sector, and the rest from households. Now, this is measured through gross fixed capital formation, GFCF, as is the norm. Capex over the last few years has clearly been policy led, with strong center support that helped show up in an increased share to just above 25%. Sector-wise capex breakup for 2023-24, which we call as FY24, shows a sharp 410 basis point increase in public sector capex spending to 25.2%, with focus seen largely in services-related capex. Services segments like public administration, defense, trade, hotels, and transport communication have received a large share of capex spends. These segmentations saw more than 80% of incremental public capex spending in FY24, a large bump up in both absolute and relative terms. While these segments have seen a rising focus, utilities capex like electricity, gas, water supply, etc., have witnessed much lower public sector spending since the pandemic, probably on the financial stress experienced by power distribution companies. Public sector capex spends always have a services bias. However, since FY19, there appears to be a particular shift towards services capex to a 64% share from 51%, a shift upwards of 13%. Did you know the share of listed companies in capex growth has been on the rise in the last few years? Before we get to listed companies capex, let's first talk about private sector capex. While public sector capex has a services bias, private sector capex always has a manufacturing bias and now stands with 1/3 share in manufacturing, back to where it was before the pandemic. FY24 saw moderation in private sector capex on the back of manufacturing and a drop in the services sector capex, particularly in the trade hotel space. Private capex currently is seen to be relatively more muted in comparison to public sector capex. Remember here that markets always give patient investors opportunities to play various broad-based macroeconomic cycles. Muted global growth and the ongoing global uncertainties around US tariffs always tend to weigh down and have a direct influence on the investment climate and, as a result, capex. It does not always keep raining. And like they say, after rains comes sunshine. So when global and domestic growth momentum picks up with reducing uncertainties, private capex always tends to perk up. Until then, public sector capex tends to step in to offset the weakness in a counter-cyclical way. Now for the listed universe bit. Data on capex of listed and unlisted companies taken from CMI's aggregation of cash flow statements of 26,000 plus companies show us a fascinating trend. Listed companies' capex reiterates a bottoming out in FY24 as well. The share is rising. It's okay, but how is the growth? FY24 saw 10% plus growth for listed companies' capex. Now, while this is certainly lower than the immediate few years, it is the highest growth seen since FY12 until the pandemic. How do the center and states spend on capex? Two sectors stand out: transport and urban development. Public sector support for India's capex can partly be seen through the respective allocations to various ministries and focus areas. Transport and urban development stand out. If one were to examine the central government's spending priorities, two key sectors stand out: railways and roadways. Now, these two account for 52% of capex spending, a sharp increase from 20% seen during FY12. Now, this increased focus from the center has resulted in a directional drop in defense capex over the years to a 17% share in FY25 from around 33% in FY19. Now, how does it look for states? States' list of priorities throw up transport and urban development as its top priorities. Now, that has been gradually trending higher with a decadal average share of around 37%. States' share of urban development capex stood at 18% in FY24, up from 11% in FY12, and transport capex stood at 22% in FY24, up from 18% in FY12. Now, the rise in these two segments has resulted in the state's share of irrigation dropping to the current 15% from 22% seen during FY12. How is capex spending growth for the center and states looking like now? The centers and states' capex spending growth is holding up quite well, with some capex moderation seen for the states. One must remember here that while the center's capex is expected to continue, with a number of state elections ahead into the next couple of years, aggregate state capex could witness some moderation due to probable pressures from populist fiscal spending. India fares quite well on capex. How do we say that? For more than 2 decades now, India has maintained its capex intensity of just over 30%, with its peak at 36% pre-global financial crisis. How do we measure capex intensity then? We do that through the investment ratio, gross fixed capital formation as a percentage of GDP. India's investment intensity stands well above the global average of 26% and ranks only lower than South Korea, 32%, and China, 40%. Can one measure how efficiently India allocates its capital? Yes, we can. The metric used for this purpose is the incremental capital output ratio, or ICOR. ICOR measures the additional amount of capital needed for a unit of growth. A lower ICOR therefore means the country's capital allocation is more efficient. The 2010 to 2020 decade saw average real GDP growth 30 basis points higher at 6.6%, with 100 basis points lower investment ratio, implying an ICOR of 4.7x, well below the ICOR of 5.1 seen the decade before of 2000 to 2010. India appears to be getting increasingly capital efficient. Post-pandemic, the ICOR moved further lower to 3.9x. Continued focus on investment alongside supportive global growth is likely to push India's growth potential much higher, and this will show up in a lower ICOR.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.